We're going to turn now to, rather than take a call, we're going to talk to our head of wealth planning, Victoria Bogner. And Victoria's been, she's been on this program a few times over the last years. And I do some webinars with her, and she's always great. And so, Victoria, thanks for joining us today.
Yeah, happy to be back.
Yeah. She's got a bunch of initials after her name. A bunch.
Yeah. You know, like early in the program Pat, I was talking about those people that are like really smart.
Yes.
That's Vicky.
You're like, you just dress well. Scott just dressed well. Vicky,
I know how to
she's
surround
really
myself with really smart people.
Yes.
Well, dressing well goes a long way, too.
Yes.
So tell us about a client situation, a financial planning issue that you dealt with.
Yes. So this comes up often. I would say multiple times a week. We're talking with clients or prospects about this particular issue. And this gentleman, I'm going to call him Daniel. He works for a blue chip company. So he's not like working for an NVIDIA or Apple, but something that's just a company that's been around for a long time and they've done really well. And he's an executive. And you know what that means? That means he's gotten paid every flavor of equity compensation that you can think of, right? So he's got a mountain of RSUs, which means restricted stock units. That's what that stands for. He's got a ton of ISOs, and those are basically stock options, right? That he got when, of course, the stock was cheap. And then he's got this employee stock purchase plan money to go along with it as well.
What was the last one? What was the
stock purchase plan?
Employee stock purchase plan. So he's been also participating in the employee stock purchase plan. So
not an ESOP. You're just talking about the stock purchase plan. You can buy it at 10 to 50% discount.
So he's got the RSUs, the ISOs. I know it's like alphabet soup this morning, but this applies to so many people.
And no idea his cost basis in a stock purchase plan.
No clue. So he has a net worth of about $5 million, but 40% of this was tied up in his company. So it's not only a huge tax liability, it's just a financial liability. If this company, if something goes sideways, not only do you lose your job, but you lose a lot of your net worth.
And how old?
So he's in his mid-50s.
Okay, thank you.
Yes. So he's worked for this company for a long time.
And it's the time in your life, most people at this stage in life are less concerned about becoming wealthier and more concerned about going backwards.
Yes, and I feel like people at this stage in their life, their career is going well. They're still a ways away from thinking about retirement. And so they're not necessarily thinking about how to be proactive with their financial planning and especially tax planning. They're just letting life happen to them as far as finances go, right? So that's what was happening to Daniel. He has these RSUs that are vesting, and when RSUs vest, and by the way, when I talk about taxes through this story, none of this is tax advice, okay? We're just doing tax planning, so I want to put a pin in that. But when you have RSUs that vest, in the year that they vest, that's ordinary income on your taxes.
And for the rest of the listeners, what amount is ordinary income? So you get some restricted stock. They vest over a period of time. How is that ordinary income calculated? The value of the grant?
It's basically the value of it that vests in that year. So if you've got, so many units of restricted stock, 5,000 units, and 1,000 of it is vesting and the stock price is $100 a share, then you take $1,000 times the $100 a share, or what did I just say?
Yeah.
shares times the $100 a share, and all of that gets added to your income. So it's like $100,000 of ordinary income on your taxes.
Yeah. Which is a challenge.
Which is a huge challenge. Yeah. And then in addition to that, you've got these stock options that, let's say that you were granted the optionality basically to buy the stock at $10 a share, and now it's trading for $100 a share. And they're going to expire soon, so you want to actually exercise these options. Well, the issue is if you exercise those options, then the spread between that $10 and $100, however many shares you decided to exercise, that is basically a paper gain. You don't actually realize that gain, but it goes toward alternative minimum tax calculations. So if you're not keeping all of this straight, Okay, if you're just letting your financial life happen to you instead of being proactive and understanding the impact of all of these different employer compensation packages, then not only are you potentially paying alternative minimum tax, you could also be paying what we call NIIT, which is net, gosh, I'm blanking. It's NIIT, net investment income tax. Thank you. There's so many acronyms. So if you're tripping both of those, you could be paying tens of thousands of dollars in tax that you could have avoided if you were just a bit more intentional about how these pieces fit together.
Yeah. And it's things like that. And I mean, the ISOs, because when you exercise your option to purchase the stock, you come up with the cash to purchase the stock.
Yep.
And then if you hold the stock for, I believe you need to hold it for a year to trigger long-term capital gain. And so, I mean, I've been around long enough to see people exercise the right to buy the stock. They want to wait a year to turn short-term gain into long-term gain, and then the stock craters.
And then, right? And they actually have they have less value than actually. I've seen it where they've had less value than the tax they actually owed on the stock.
I have
because
too.
they didn't because they didn't put
and
it
then
down.
And then they end up with a tax bill of, or they.
Yeah. So
the NQs are the ones that can bite you too.
So what did you do to help this person?
Yes. So what we did is, first of all, sat him down and said, "What is it exactly that you have?" Of which he said, "I don't know." So we went into his Fidelity account.
A bit to his defense, I mean, accumulators, good accumulators. This is often the way they go because like I want to ignore those dollars. I don't want to be tempted to take those dollars and convert it into current lifestyle. So I'm going to pretend like they don't even exist.
Correct. So first of all, it's just getting an accounting of what in the world are we working with here. So we have RSUs that have different vesting schedules. So we need to figure out when are these RSUs going to vest so we know exactly what the impact on ordinary income is going to be. Then we have the ISOs. So we need to know what are the exercise prices of all these ISOs, all these options, and when do they expire? Because that's the piece that you can control when you want to exercise those ISOs. You can't control when your restricted stock vests. You can control the ISOs, and then you can control when you sell your employee stock purchase plan stock. So Daniel is also very charitably inclined. So this is a trap that sometimes I see people fall into, is that they think, oh, well, I'll just exercise my ISOs, sell the stock, or no, pardon me, they'll donate the stock. So they'll say, well, I'll just take that and I'll put it in my donor advised fund right away. And that's a big mistake, because what happens is when you exercise that ISO, that amount, that phantom gain, goes toward your alternative minimum tax calculation. But that particular stock that you donated to a donor advised fund because you held it less than 12 months does not come back off of your alternative minimum tax calculation. It comes out of your ordinary income tax calculation. But the way that the tax code works is that you actually have two different taxes that are separate, two different tax calculations. One's your ordinary income tax and one is alternative minimum tax. And you pay whichever is bigger. So if you're donating stock that doesn't come off of your alternative minimum tax balance,
because you haven't owned it for 12 months,
and that's going to be the bigger one, that's the one you're going to pay.
Yeah, and the reason it doesn't come off is because you haven't owned it for 12 months.
Correct. That's right.
The quirk in the law. I mean, they've created there's two tax, right? There's two tax laws.
And the and Victoria, the alternative minimum tax, we didn't see it for a couple of years because of the changes in tax law, but now it's starting to rear its head again.
Yes.
Yes. Yeah. And then it becomes even more complex, because when you pay alternative minimum tax on like that phantom paper gain from your ISO being exercised, then in future years, that becomes a credit for you when you're paying ordinary income tax. So every year you want to make sure you're working with a financial advisor and your tax professional to figure out, when do I want to strategically exercise these ISOs and when do I not? So I'm not just building up a bunch of alternative minimum tax credit that I'm not using, because in order to use that credit, your ordinary income tax bill has to be bigger than your alternative minimum tax bill. So I'm saying all of this because it can get very complex very fast. And many executives that have these RSUs and ISOs and all these moving parts really don't understand how all these pieces move in tandem together, and they get their tax bill at the end of the year and they're like, holy cow, my entire bonus went to paying taxes. Why is that? Well, it's because you didn't understand how these pieces work together and how to be strategic around, charitable giving, when to exercise the ISOs, and how the RSUs are impacting your taxes.
And what did you do about his 40% exposure to a single company?
Well, what's great about this particular client is that for accredited investors, and those are ones with over $1 million in net worth, investable net worth, there are more options open to accredited investors than those that are below 1 million. Of course, most executives that have this problem fall into that accredited investor bucket. So there are ways in which we can diversify folks with a concentrated stock problem very quickly while deferring capital gains at the same time. And then also we were able to look out several years so that we could see when the RSUs are vesting, and in the years where he doesn't have much that's vesting, we can exercise some ISOs. And then, since he's very charitably inclined, take some of the RSUs and donate those, not the ISOs we haven't held for more than 12 months. So that's also taking down his exposure in this particular stock.
Can you spend a minute talking with our listeners about these investment pools where someone with
what strategy were you talking about?
Where you had talked about where you have a way of actually mixing them in the
yes.
pool. And
there are a few.
And do the investment pools, they can turn down they have the ability to say, no, we don't want that particular stock, do they not?
They do. If it's a very common stock, like one of the common mega cap stocks, they might turn it down.
Yeah, so these are exchange funds, right?
They're exchange funds.
All right, explain to us
go
kind
ahead.
of the basic concept behind it, please.
Yes, the basic concept of an exchange fund is very similar to like an exchange traded fund that I'm sure you're very familiar with on the stock exchange. It's just that these aren't publicly traded. They are exchange funds in which you give over your concentrated stock position, and in exchange, you're given a pro rata slice of what everyone else in that exchange fund has contributed of their particular concentrated stock position. So you can see why they wouldn't want all Apple contributions, right? Because they're trying to diversify this exchange fund for everyone.
So it would be like the three of us get together. I own ABC stock, Pat owns XYZ, you whatever, and we all say, let's come together.
And we form a little pool, and I throw mine in, you throw yours in, Victoria throws hers in, and
it's not a taxable event. Right, when you do
it's not taxable.
Follow the right kind of rules.
In exchange, we each get a third pro rata of what was contributed, right? So you're instantly diversified, but you've deferred your capital gain.
And how long is the holding time on these exchange funds in order to get favorable
Generally, it's 7 years is the average. So this isn't a short-term strategy. It's something that you need to hold for a while. Now, there are exchange funds out there that have much shorter hold times, but in general, it's 7 years. And then at the end of that 7 years, you get a basket of all of those individual stocks, and your cost basis is spread equally among them, pro rata, so that then you're fully diversified and you can be very surgical in which ones you decide to
blows
sell.
my mind.
You know why? Because Congress comes up with this convoluted tax structure, right? They put a bill, they sign it into law, and then the attorney's all right, how can we structure something to accomplish what we want to accomplish and still be in compliance with the tax law?
I know, but think about when you entered the business. I've been doing this for almost 40 years. When I entered the business, the idea, these were in their infancy, but they were not sophisticated. They were super expensive because there wasn't technology that could drive it, right? And so you look at it now, and look, our industry gets a bad reputation
because we sell all kinds of crap.
But there is so many good things as the industry matures. There are more tools available, and the sophistication.
Well, the industry on the fiduciary side. We're fiduciary independent advisors. A little different than we don't manufacture stuff.
That's right.
We find the best solutions for our clients as opposed to this other department that we have has the strategy that.
But Scott, you think about 15 years ago, before we actually started bringing these other firms into our fold, there was no way we could spread this sort of sophistication across our own client base. You had to get to scale from a business standpoint.
For sure.
It wouldn't have worked.
And a little tiny independent advisor,
How do they compete?
They don't. I had to talk to an executive yesterday at Schwab. That was a conversation we had, high up at Schwab, and he just reached out. He says he'd like to talk to founders every once in a while and get their view on where the industry's at. And I thought it's pretty smart of him. Not that I had any good ideas.
I know, but then did you call Charles Schwab afterwards to say I like
himself?
To do the same? Yeah.
Shocked me like I'm probably out of the business by now. But the whole concept of like how in the world is a small independent advisor? One person can't keep up with all this stuff.
That's right.
That's absolutely right.
All right.
Yes.
We have specialists internally on these various techniques to work alongside our advisors, because you can't expect one CFP to know how to implement all these things.
But this has turned into a little bit of a commercial about
Correct,
our firm.
Yes, of course.
But it
not just our firm.
It's just not our firm. There are large firms across the United States that do similar techniques. There's probably
30 or 40 of them.
Yes. So did you put them in a pool? Did you use any other instruments to put some downside protections on these RSUs or ISOs?
Yes. So this particular gentleman isn't an insider, so he doesn't have to be subject to windows, although we do work with a lot of executives that are. But in his case, we were able to use what's called a collar strategy, in which we put guardrails around the stock, and it's actually cost neutral because we put a cap on how much that stock can go up, but usually cap's pretty generous, like 15 or 20% in a 12-month period.
So you sold that.
Yep, in order to buy what's called a put option, basically the option to be able to sell the stock at a certain price below what it's currently trading for, because that means that we know, we're only going to take, let's say, 10% downside risk, and then after that, we're completely covered. So that then if this stock, for whatever reason, craters or the economy goes sideways, we know exactly how much risk we're taking with that particular stock. And it's so important too. It's like you don't want to let the tax tail wag the investment dog, right? You don't want to feel like I'm just going to hold this stock forever because there's this huge tax time bomb. But there are so many different strategies to be able to divest of this stock and diversify you properly without feeling like you just have to sell it all and blow up your tax bill. They really go hand in hand.
How the client to understand these strategies, did it take a number of meetings? Was it pretty clear to the client? It's how the advisor presents it to it, oftentimes with graphics to help understand the machinations behind what we're actually doing. How quickly was the uptake from the client, or not this specific client, let's say the normal client? How long was the understanding, like the aha moment?
I think a normal client, a typical investor, probably takes maybe 3 meetings, and and it depends on years who are like, I want to know every single detail of how this works. And then you've got the folks that are like, sounds good to me if you say so. But of course, we want everybody to do their own due diligence. You are the one that is ultimately in control of your financial life. We're coming alongside to give you fiduciary advice. But we do have a lot of tools in the toolkit to be able to make it so you're not just forking over tens of thousands of dollars in tax that you just don't need to, because we get client stories, and I got one this morning. So the marketing department, which actually helps us generate people that are interested in our firm. We
love what we do. We think we provide a lot of value, and we'd like to do it to more people, and we think more people are better served here than the vast majority of other financial firms.
So I received this client story this morning that said that someone had watched yours and Scott's webinar and had said that they thought that the advisor was only a stock picker, basically, and that there was very little value added in the rest of the relationship, which isn't. I mean, there isn't a time that I've never. I mean, I was driving into the show this morning, looking forward to speaking with you because every time I do, I'm like, wow, I didn't know that, and I've been doing this a long time. So,
well, Victoria, thanks for
Yes.
taking some time to be part of the program today.
yeah, I'm your number one
absolutely. My
fan.
pleasure.
Number one fan right here.
Yeah, thanks. Thanks.
In fact, Scott, if you ever want to drop off the podcast at some point in time, Victoria, you're welcome to join me.
I'm here. I'm always here for you.
All right, thanks.